the direct exposure of life insurers at the global level to direct lending is still not very high. However, we are seeing an increased level of direct corporate lending within specific pockets of the market.
This podcast is for informational purposes only and does not constitute investment, legal, or tax advice. The views expressed by the host and guests are their own. Listeners should consult professional advisors before making any investment decisions.
Welcome to Fixed and Floating, the credit podcast. My name is Josef Pschorn, and in each episode, we explore the forces shaping credit market. Today's episode is very special. I'm today joined by my former Royal Bank of Canada colleague, Jakub Lichwa. He was the first person to truly open the door for me into the world of banks and insurance. And to this day, whenever new regulation drops and I'm trying to figure out what's going on, he's the first person to call. He brings a 360-degree view of the financial industry. He'd covered it from every angle. He was at Moody's, then he went on to Goldman, and now he's overseeing financial institutions at TwentyFour Asset Management. The only thing missing to this date is a stint at a regulator. So Jakub, when's that coming up?
Well, this sounds like a career-ending move, so hopefully not anytime soon, in case my employer is tuning in. But yeah, thanks, Joseph, for having me here. I always appreciated our interactions, and yet again, looking forward to another discussion today.
Yeah, so my first two episodes looked a lot at corporate distress, one at a broader level and the first one specifically at First Brands. And in both cases, private debt was coming up. So I'm trying to understand what's actually driving the growth of private credit. And what we see is that life insurers also play a very big role in that growth and are now also large allocators to the space. So I'm just wondering, how can we think about the insurance industry and its growing connection with private credit?
Yes, look, so there is certainly been increased focus from global regulators, around the life insurance sector and its linkages to the private credit. And the sector plays a critical part and role in the financial landscape. They provide protection and saving products to households and really represent a key source of funding to the governments and the real economy. To give you some figures, life insurance manages about 25 to 30 trillion, or about 8% of global financial assets. From where I sit with my experience, I feel that direct exposure of life insurers to the private credit at the global level still looks contained. However, it is the complexity of some assets and capital relief measures that are being undertaken, especially in the US, and together with the growth of the private credit, which means that the stability risks related to this pocket are certainly growing. Now, when we look at the European life space, here we have seen a far more measured pace of growth in private credit, which gives me more comfort around the resilience of the sector to the next credit cycle. But they're never immune to the contagion out of US.
Before we dive a bit deeper into what insurers actually do, would you mind giving an overview of private credit actually is and how we can differentiate it towards other assets?
Sure. Look, I think it's a really important distinction to make right at the start, and especially in the context of life insurers and their broad asset allocation. So the first thing I'll say is that private credit is not the same as alternative investments, and direct corporate lending is not all private credit. And specifically, when you think of private credit and what it includes, you have infrastructure lending, so lending against toll roads, airports, energy infrastructure. This lending is project-based. Other types of private credit include commercial real estate, capital relief, social housing, housing association lending, and finally the direct corporate lending, be it high yield or investment grade. And this is often what media refers to when they say private credit. Direct corporate lending represents only about 50% of private credit globally. And in this type of lending, the outcome depends on the overall quality of the borrower rather than the specific project. This is also part of the private credit that has experienced the strongest growth and is projected to continue growing significantly in the coming years. And now when we look a little bit broader, at alternative investments, what does that mean? I mean, it includes private credit, but it also includes private equities, hedge funds, CLOs, ground rents, equity release mortgages, and real estate. So, look, the main point here is that private credit term is being used very vaguely. But it is important to keep these distinctions in mind when we look at the life insurance sector, their balance sheets in different regions, and the growth dynamics in the last few years that affect only specific pockets of this asset class.
So you just drew a line between private credit and alternatives. But if you take a step back, why are life insurers investing at all in private credit? And how do those investments match with the promises they have given to policyholders?
Look, so maybe before we talk about the exact investments that life insurers make, it's worth actually thinking a little bit and taking a moment to consider how the life insurance model makes money. And Warren Buffett described it very simply in a sentence, and he basically said, we get paid up front to hold other people's money and we invest it. And that really sums it up. At its simplest, life insurers collect premiums from policyholders that exceed the expected claims that they expect to pay out over the life of the policy, plus any associated expenses. And the difference that they make will be their profit. So, to give you a real life example, term life policy. A policyholder will make annual payments, $200, $300 per year, and to insure against their death. The life insurer will collect these premiums and will invest them. Most people cancel their term life insurer before the age of 55 because the policy premiums become prohibitively high. Clearly, life expectancy is longer, so this ends up being a pretty good deal for the insurer. Another product is annuity, which is a big money maker. And here, what insurers are doing is they are pulling mortality credits, or in other words, those people who die early subsidize those who live longer. So, again, to give you an example, you have a 65-year-old, they make an upfront payment of $1 million and upon their retirement to buy an annuity to have, cash flow to enjoy the cash flow during their retirement. If they die at 75, the insurer keeps whatever was not paid out to them. If they live until they are 100, the difference gets paid to, the difference will be paid by those who died earlier. So clearly, the trick is to correctly estimate the life expectancy of a large group of individuals to ensure that, all the policyholders don't live beyond their estimated age. It's difficult to do it, to estimate the life expectancy for any single individual, but it can be done much more accurately at the group level. So hopefully, that gives you a sense of how the sector makes money, and the words of Warren Buffett ring true. So, and taking it a step further, now we established that life insurers collect the policy premiums and they need to invest in assets. So what assets are suitable for them? In terms of suitability of assets to invest in, the first point I'll make is around the comparison to banks, as they represent another major creditor to the economy. Long story short is that the long-dated nature of insurance liabilities, like annuities that we just described, represent a natural home for long-duration assets. Just, to circle back to the example of annuities, when a client buys an annuity, the insurer will be committed to paying out a stream of future cash flows for a long period of time. In other words, this will create a liability on their balance sheet. At the same time, the insurer will have to invest the proceeds received in some asset that will provide adequate cash flows to deliver the promised payment on that annuity. And the nature of the annuities can be very long, in some cases over 40 years. It will always be challenging to find attractive assets that match the duration of the long liabilities. As a result, the insurer will face investment risk, or the risk that they will not be able to find assets with adequate yield once the other assets, initial assets, come up for refinancing. And on the opposite side, banks normally fund themselves in short-dated liquid deposits, liabilities, and as a result, they face more of liquidity risk. The point of everything I have said is that assets with longer duration, which are less liquid, are more naturally suited to the balance sheet of insurance firms. Banks, on the other hand, are better at holding short duration assets.
I guess that's also an important point, that insurers don't really face the risk of a bank run, which banks are very prone to.
Indeed. So there are risks for insurers around the loss of their liabilities. This is referred to as lapse risk, or the risk that certain policy holders will terminate their policies earlier. And certain policies are more prone to this risk than others. However, insurers are able to look back and understand better behavioral aspects of what the clients are doing and plan for that in their asset allocation. On the other hand, as you said, whilst banks can monitor some of the behavioral aspects of the deposits, the nature of the deposits is inherently short. In many cases, overnight. A stress in the banking sector can very quickly feed the nervousness and the deposit run, as we have seen time and time again in the past. But one other point that I also wanted to make with regards to the asset allocation, and maybe going back to why the insurance sector is the natural home for long-dated assets, relates to the history of the insurance sector. I think, again, it's important to appreciate how the history has shaped the asset allocation that we are seeing now globally. be it in Japan, US, or Europe. All the way from 200 years ago, life insurers have always been present in some long-dated assets like mortgages and real estate. They are present in these assets to this day. Since 1950s, the US insurers have seen some increased allocation to equities, although it has always remained secondary to fixed income assets. Between 1970s and 1990s, smaller and medium-sized US insurers have increased their allocation to a high-yield market following the boom in junk bonds. This has culminated in the failure of Executive Life in 1991, and hopefully we'll come back to that later. In the meantime, in Japan, in the 1980s, Japanese life insurers have been involved in direct lending to the real estate sector. And this has culminated post the bursting of the bubble in the 1990s in a number of high-profile failures of Japanese life insurers in the late 1990s. This has also shaped their current risk aversion in the investment portfolios. Now, if there is one thing in terms of asset allocation that I would want you to take away from this podcast, is that the asset allocation in the last 20 to 30 years has been heavily shaped by the low interest rate environment. And here, we can start already with AIG, that the low interest rate environment has contributed to their involvement in writing CDS contracts on collateralized debt obligation on the US housing market. We know how that has worked or didn't work for them.
You're talking about the period pre-Great Financial Crisis, right? Between, let's say, 2003 until 2007,
Yes.
right?
Yes, that's correct. And then, low rates have also pushed equity prices of life insurers lower, making them an attractive target for PE firms that were seeking demand for the assets that they were originating. Insurance firms have also grown their share of alternative investments during this period of low rates, as they were trying to replace some of the maturing assets that they held in their general account. Some insurers have also increased the sales of unit-linked products. These products pass on the investment risks to the policyholders, with life insurers only collecting the fees. And higher rates after COVID have only exacerbated some of these trends, as we have seen a huge demand for annuity sales that in turn fueled the demand for assets from the life insurers. So the bottom line is that in the entire history of the life insurance sector, some long-dated assets have always been part of the balance sheet allocation, and they are natural because of the longer duration of liabilities. Significant excesses on the asset side have been associated with problems of life insurers in the past, and the low rates post dot-com bubble, post 2000, have challenged the life insurers' business models and have encouraged higher risk taking, with insurers seeing higher proportion of alternative investments in their general accounts.
So it seems that the zero or very low rate environment has pushed insurers towards, if you would say so, more risky investment behavior. And one product they have invested in was also private credit or senior direct lending. If you narrowed it down to only lending to corporates, how much of that risk of that market sits on insurers' balance sheets as of today? And what does this also imply for risk and market dynamics?
Okay. So in terms of the actual numbers, the estimated size of the private credit market out there globally is about $3 trillion. As we mentioned before, the direct corporate lending represents only a subset of private credit, which is about half of the private credit out there. So let's call it 1.5 trillion. Now, life insurers hold about 25% of the direct lending market and the private credit market. So, and I also did say initially that the assets of life insurance sectors sit at about 25 to 30 trillion globally. So when you think about it, the direct exposure of life insurers at the global level to the direct lending is still not very high. There is certainly still more room to add to the investment allocation. But these are obviously just the high level numbers at the global level. I think what is more interesting is, what is more interesting is actually the fact that, there is still complexity. Even though these allocations may be small, there is still complexity about them. There is still certain concentration risk about them. And finally, you have to actually remember that we are also past the period of a very rapid growth, which is, all of which are obviously attracting a lot of regulatory scrutiny for all the right reasons. So, again, in terms of the complexity, I guess it follows from the definition, private credit or direct corporate lending will always be opaque. I mean, markets will have less information about this asset class and this pocket of the market than they do about public markets. As an analyst, one problem I have is with the lack of details around disclosures, in particular the underlying asset quality. When you think of, as an example, when you take banks, they classify their lending in stages: stage 1, 2, and 3. Stage 3 being effectively a non-performing exposure. Stage 1, absolutely fine. Stage 2, something in between. You cannot get that. Well, you can actually then observe the exact migration of lending exposures between these asset classes from one quarter to another. It gives you certain comfort and insight into those exposures. Now, what insurers are doing, life insurers are doing, they are disclosing a point in time snapshot of their investment books. There is very little clarity as to how these investments have evolved in terms of their underlying risks. There's only a handful of insurers which are disclosing the movement from one rating level to another. But even then, these disclosures are very minimal. The risk or fear here is that, especially around the private credit exposures or direct lending, that some valuations will just move from par to zero overnight. And we had those headlines in press, right? So, it is this lack of visibility that creates the general unease among market participants. And I don't want to be too philosophical here and digress too much, but I think this is actually part of our psychology. As humans, we really struggle with uncertainty because our brain is, fundamentally wired for predictability and control. And we always seek some explanations, even if they are not correct. So yeah, I think the main point here is that uncertainty is in private markets is counterintuitive to how we think, and probably the participants in the private credit market would do everyone a favor, including themselves, if they put a bit more spotlight on what's happening, behind the scenes there.
So you would say that people would much rather prefer less creditworthy assets, but if they are transparent, versus better assets which are non-transparent?
Yeah, what I say is that a person, an analyst or an investor, is able to better assign a certain level of risk when they have specific information about the underlying riskiness of the assets that they are dealing with. So in your example, if the assets are of weaker quality, they will just assign a higher amount of reward to it, higher spread, and they will move on. When you don't know what you are dealing with, then you only rely on the trust. And then you start facing questions around the credibility of underlying ratings, credibility of the analysis that has been done. Again, you want to feel that you have done that work for yourself. And it is not easy. It is not easy to get that comfort when you are looking at disclosures of life insurers.
That makes a ton of sense. I think one point which is still missing is on which you wanted to expand upon is concentration.
Yes, yeah, sorry. So in terms of concentrations, so so as I said, the direct lending exposures as a whole at the global level do not seem to be out of line or do not seem to be posing systemic risks. However, we are seeing is an increased level of direct corporate lending and private credit within specific pockets of the market, like US life insurers, like private equity owned US life insurers. Another aspect of this concentration is the fact that a large share of direct lending has been originated to the software segment. This obviously clearly increases vulnerability of the asset class as it links it more closely to the tech sector. And you know that we have had a fair few headlines, recently around tech. So it adds to this general unease from the investor community. And one other point I wanted to make is actually about growth, which I think is very important in the context of the direct corporate lending. Um, you know, and why it is a major flag at this stage, or at least a red flag. When you think about the right level of growth in the economy, you can compare that to the actual real GDP growth. When you look at IMF, they think that the right level of credit growth can be up to a few percentage points higher above the real GDP growth. When I was at Moody's, we thought of a growth that is 2 times the GDP as raising some stability risk questions. When you look back a few years since 2018 pre-COVID period, US GDP has grown 22%. Bank lending, commercial bank lending, has increased in that period 30%. The direct credit lending during that period has doubled in size, right? That's a big growth. Now, this is not to say that all the private credit or direct lending exposures are going to turn out bad. Far from it. However, at a minimum, the pace of growth means that the large pockets of the market are very much unseasoned and they have not gone through a period of recession. So, all this is actually just a long way of saying that direct corporate lending at the moment does not, from my perspective, does not correspond to a large proportion of life insurers' balance sheets at the global level, but the opacity of it, the growth of it, certain concentrations, both at the sector level and in the specific US life insurers, mean that it still necessitates closer monitoring because it can pose stability risk through contagion.
You've just shared that a lot of private credit risk is centered in PE-owned US life insurers. Would you mind sharing a bit of light around how exposure to private credit differs around the globe?
Sure. I think we can start here with a Japanese. We can start here with Japanese insurers. And why? I think it's actually a nice place to start because post the crisis of 1990 that I've mentioned, they have significantly deleveraged their investment portfolios, and they are exhibiting the highest risk aversion among the major regions. And one of the big shifts that have happened over the last 20 years there is a significant reduction in direct lending exposures. A lot of the direct lending was done to the real estate segment, and growth in foreign securities, that's primarily bonds. So, the share of alternatives in the investment books of Japanese lifers is, again, very low, although that percentage is growing. I mean, they are not immune, obviously, to the challenges of the low interest rate environment, and they do need to find avenues to stay profitable.
Just one question here, because you've mentioned that especially the low rate environment was a big issue for insurers. What did the rate hiking cycle, or now the environment of higher rates, mean for insurers?
So the rate hiking cycle has not dramatically changed. Well, what the rate hiking cycle has done, it has fueled the demand for the traditional life insurance policies, like annuities. That demand has been subdued in the run-up to the higher rate environment, simply because policyholders did not find these low-yielding policies attractive. Because of the sales of the annuities have increased, that has created additional demand from the traditional life insurance sector for the assets. What we have also seen, and that's partly related to higher rates, but also the supportive environment, what we have also seen is credit spreads tightening over the last 2 or 3 years. Again, the annuity sales are continuing. Life insurers need to add to their investment portfolios during this time. They need to reach out for alternatives to meet their yield targets. So they are back in the pool. They are once again adding to their alternatives allocation. That doesn't mean only private credit. It can mean mortgage exposures. It can mean commercial real estate. But they are continuing to add to those alternative investments.
So it's fair to say that we have only seen a very, very short amount of time, for like around 2 years, where insurance haven't really added risky products, or haven't had the need to add risky products, because like the overall level of corporate and government debt was enough to satisfy their liabilities.
Yes, that is true. But what I would say is that the strategies of asset allocation are very, very different when you look at different regions. They may differ because of the regulation. They may differ because of the attitude towards risk. And let me make this as a segue to the US. I can give you an example of Athene. Athene, is an affiliate of Apollo. They were set up in 2009 during the global financial crisis, and they provide retirement services, annuity products. Their share of corporate and government bonds in the portfolio is only 37%. They have all sorts of colors of alternative assets in their asset allocation. Um, they will have different incentives. Being private equity owned, they will have different incentives when they decide on their asset allocation than other insurers.
How much of the exposure of Athene is then approximately to senior direct lending?
Yeah, I think it's difficult to disintegrate it. Long story short, when you look at the breakdown that is being provided, it's going to be very low, just under 5% of total exposures. However, you know, um, the economic exposure will be higher because when you consider that their CLOs, ABS, and some mortgage-backed securities can have direct private direct lending backing it, then obviously the exposures increase significantly. So, one lesson from this is when you are looking at the company, Athene, or any company that is actually disclosing a 99% holding in investment grade bonds, you really should look a little bit what's behind those investment grade bonds. And I'm actually just picking on Athene here, considering their linkage to Apollo, and they are obviously, quite a bit in the headlines with regards to again, their involvement in the private equity sector. But again, this is not to say that that in Europe, life insurers are not increasing their share of alternative investments. They've been also subject to the low interest rate environment, and they are challenged by the same dynamics. What I would say though is that in Europe, the alternative investments are skewed towards products that are mortgage related, at least for the moment. Private credit still represents a smaller portion of the overall asset mix. And some of these considerations for the asset allocation stem from the regulation. Some of them come out of the attitude towards risk. But I'll give you one example here. In the UK actually specifically, because it's quite interesting. UK insurers are increasing their presence in private credit. So what's going on there? In the UK, the regulator promotes or is happy for life insurers to use the concept of a matching adjustment. This concept allows the insurers to match predictable cash flows from liabilities with the assets in order to receive preferential capital treatment. So the insurer will normally find it difficult to source very specific and particular assets in a public markets because they need to closely match the cash flows of liabilities. So it is actually much easier to custom make these assets in private markets. And so, naturally, the push for the matching adjustment will be fueling the demand for the private assets, be it infrastructure lending, housing loans, equity release mortgages, etc., etc. Then you go outside of the UK and you look at the Dutch or French, and then you have to actually they take a bit more mixed approach. The regulator does, and then you'll find that there's a higher share of mortgage-related exposures or equities in their investment portfolio. I think again, we've talked a lot about this asset allocation globally. The key takeaway for me is that the asset allocation varies considerably across different jurisdictions, and you can't make a single judgment as to what exactly is happening because rates are currently a bit higher. What you can say is that the trend of increasing alternative investments is still here to stay, and that applies to Japan, US, and Europe.
So what's then the deal with private credit companies holding ownership in insurers? I mean, it seems that regulation clearly drives how insurers shape their portfolios, but is this also the reason why private credit firms scoop up insurers?
Yeah, so look, I think in order to fully understand the mechanics uh, between the private equity and the life insurance relationship, and how the value is created in this cooperation, um, you need to look at the so-called virtuous flywheel, which has three key components. And the first element of this virtuous flywheel is the selling of insurance at scale. This is the key component to this model. You need an insurance firm at the start. And this is where Apollo set up Athene in 2009, and why we had actually more takeovers of insurance firms by, and we still have them, by private equity operators or private credit operators. The sales of the insurance products can be done directly to end clients, or they can be done by buying back books of other life insurers. Other life insurers would sell you the back books because of the capital optimization efforts. They may be willing to exit certain lines, whatever the host of reasons they may have. But these sales of life insurance policies create demand for capital and for investment assets to back those policies. And the second element of this virtuous flywheel is capital sourcing. It's critical. You have to source capital, and that can be done in different ways. I mean, it can be done through reinsurance, it can be done through retained earnings, or it can be done through third parties like sovereign wealth funds. Capital is critical because when you're growing your sales, when you're growing your annuities, they are capital intensive. They require more capital. So you need to have that access. And the third component of the virtuous flywheel is the differentiated investment strategy. The other components mean nothing if you can't originate the assets. You need to be able to originate. And this is also promoting the setting up of asset managers and originators. And, within this circle, within this wheel, they are going to collect the fees for their service, which is yet another source of revenues. And, the adoption of this virtuous flywheel has broader implications, because private equity firms will want to secure the steady demand for their asset origination. The reliable flow of annuity policies is the single most important element of this model. Life insurers buy about 25% of private credit out there. So the chances are high that PE firms will be interested in more of these M&A transactions, and in the life insurance space, right? To gain greater control of the demand channel for the private assets. After all, these can be structured to fit the regulatory needs in different jurisdictions. So you may read some opinions of equity analysts arguing, that PE firms are buying recently, the UK life insurers because they're undervalued, because public markets are not seeing adequate value that the private operators do. But to me, obviously, private equity operators will have a look and will try to understand the valuations. But what they are really doing is they are building a moat around the business model. They are building a reliable demand channel for their origination platform. And insurers can simply provide one such steady source of funding, and having control of it for the owner is just invaluable.
That makes a ton of sense. So what you're basically saying is that a strong origination platform can clearly differentiate yourself from other public insurers which don't have the origination platform. But aside from these advantages, are there also other downside risks with this model?
Yes, I think I we could spend here a lot of time discussing it, but there are three key risks that I think are worth highlighting. And number one is wrong incentives. I mentioned earlier when we discussed the history of the life insurance sector, the failure of Executive Life in 1991. To recall some of the events of what has happened there, the management of Executive Life had closer affiliation to the management of Drexel Burnham Lambert, which was an investment bank that pioneered high-yield bonds. And Executive Life has been adding high-yield bonds to its investment book. At its peak, high-yield bonds represented nearly 70% of their general account investment. And well, they failed after that in 1991. And the rest of the insurance sector has also reduced the allocation to high-yield debt post that event. But the main takeaway here is that one should be wary of a situation where we have close relationship between the insurer and the asset originator. So that will be risk number one that I will flag.
Jakub, would you say that it would make sense from a regulatory standpoint to separate the insurer and the supplier of the assets?
The way regulation works is that we normally propose certain we create certain proposals only after we learn what the pitfalls are of specific models. So far, again, we had that pitfall obviously in 1991, although it wasn't directly related to the ownership. Strictly speaking, it probably would make sense. But again, when you actually think of the case in 1991, I mean, it's just one case, but when you think of it, there was no direct ownership between Executive Life and Drexel Burnham Lambert. It was merely a good relationship at the top of the management. You can achieve the same close working relationship even if the ownership structure is not there. So on paper, I think it could be an interesting possibility, but at the same time, it has its limitations. And let's not forget that there is also an advantage to having an asset origination platform in-house. You are possibly able to access a wide range of assets that others may not. If you actually think of some smaller life insurers, they may be limited by their capacity to originate and access assets that are attractive enough. So again, it's there are some pluses and minuses to this setup, and I think the best that the regulators could or should do is just monitor closely the asset allocation that the private equity linked insurer has. I think that's probably also the most practical solution. But look, maybe in terms of, because you ask what are the flags, what are the red flags to this model? A second red flag of this virtuous flywheel model is the reliance on growth in annuities and the associated cyclicality of the model. The current environment is optimal for life insurers. Higher rates lead to strong annuity sales, and specifically for PE-linked firms, their asset origination capabilities differentiate them from the rest of the field. However, the downside here is recession, which will likely be associated with lower rates. In an environment of lower rates, we are likely going to see significant reduction in annuity sales. As the number of policies is reduced, the balance sheets of life insurers will also decrease in size. This will lead to the contraction of the assets that life insurers hold. Now, at the same time, the economic downturn will likely be associated with higher incidence of default rates. So this will represent another pressure on the asset side for those life insurers. On top of that, within the broader group, the decrease in the assets under management will coincide with reduced fees for the asset management arms. So all this is to say that all is well when all is well and the economy is performing strongly. However, the business is highly procyclical on a number of levels, and it is prone to an economic downturn. And actually, I promised you, now I'm thinking about it, I promised you 3 red flags of the model. I've given you 2 so far. So the last one that I'll probably mention is the one that's associated with reinsurers and capital optimization tools. We're going to go into a bit more detail here, but monitoring reinsurance practices for any life insurer is important. In a standard reinsurance transaction, an insurer will want to reduce or transfer some of the risks related to liabilities. Let's say like longevity risk or the risk that policyholder will live beyond their life expectancy. So they would transfer these risks to the reinsurer and pay a fee for the service. And that's basically it. End of story. It's very simple. However, what we have been seeing is life insurers adopting more aggressive reinsurance practices in the recent years. And one such example is a so-called funded reinsurance or asset-intensive reinsurance. In these transactions, the insurer is ceding liability risk to the reinsurer, much like with conventional transaction. But what is also happening is that the insurer is transferring the portfolio of assets related to those liabilities as a fee for the reinsurance service. The reinsurer then invests this portfolio in some higher yielding alternative assets like private credit. And this transaction can normally be done with offshore jurisdictions that have preferential capital treatment for assets and liabilities, which actually will lead to a beneficial outcome for both parties. And the risk here is that the reinsurance company in question that is providing that service may actually fail. And at that moment, the primary insurers may need to recapture those risks on its balance sheet, creating a one-off capital hit. And in the UK, the regulator has been particularly vocal about these risks, and they've recently published a stress test. Well, in fact, last week, and they've actually quantified the volume of the volume. They've quantified the capital hit that the insurers would suffer if funded reinsurance was withdrawn. And again, because of that early monitoring, the overall capital hit on the sector has been really, really minimal. But the usage of this is more prevalent in the US and with private equity owned names. And another example, somewhat related, of aggressive reinsurance practices is the use of offshore affiliated reinsurers. In these transactions, the primary insurer, so let's say Athene, is transferring liabilities to a reinsurer. So Athene Life Reinsurance, which is based in Bermuda. Athene Life Reinsurance invests premiums into the assets of affiliated asset manager, in this case Apollo, allocating, again, a reasonable share to private credit. The transaction is structured in a way that Athene Life Reinsurance benefits from lower capital charges than Athene would if it kept the assets in the US or the original jurisdiction. And you know where I'm going with this by now. I mean, this mechanism leads to a situation where the capital can be managed or allocated more efficiently within the broader group for the same risks, because the capital consumption is lower in those foreign locations. So the risk here is that this mechanism is abused and the opacity of risks will grow further. Balance sheet will not be optimized for safety, but will be rather optimized for the jurisdiction which allows the most lenient capital treatment. And for some context around the utilization of the reinsurance, offshore reinsurance, major life insurers in the US have ceded over $2 trillion in liabilities, which is about quarter of their assets. And 40% of this has been done with offshore jurisdiction. And you'll see that actually you'll see on the slide that major users of offshore affiliate reinsurers are PE-owned, PE-linked firms.
You have just described that the virtuous flywheel consisting of asset management, insurance, and reinsurance adds a lot of value to insurance companies. Do we see this conglomeration of insurers only in the US, or is it also coming to Europe?
So yes, looking at Europe in terms of PE ownership, for the moment, this is largely a US phenomenon. And, BIS notes that Americas have by far the highest share of private equity ownership within life insurers at around 25%. The share in Europe is much lower, just under 10%, but it is growing. Just this year, we had transactions of Brookfield acquiring Just Group and Apollo buying Pension Insurance Corporation. And, time will tell whether, skewed incentives will influence the asset allocation and behavior of these insurers, and to what extent they will be able to adopt the same practices, say, in the UK market that we are seeing in the US. At the end of the day, the UK regulators is also seen as a strong gatekeeper to the soundness of the financial stability. Looking more broadly, and thinking about Europe and private credit, I think one must keep in mind that the evolution of private credit in Europe has been much slower than it has been in the US. The makeup of alternative assets is still skewed towards mortgage-related exposures. And, save for the UK and Germany, where the regulatory landscape is arguably promoting some increased usage of illiquids, the rest of the region is not seeing a very high take-up in private assets. Again, time will tell whether the regulation will relax and whether we are going to see behavioral changes. But at the moment, I'm certainly comfortable with the level of the private credit exposures for the European life insurers.
Jakub, thanks for joining. That was really great. You did a really good job of putting into perspective the relatively small allocation of insurers towards private credit, but at the same time also pointed out that a good origination platform seems to be vital for differentiation for different insurers. Another great point you made was that regulatory arbitrage seemed to be possible and also massively benefit private equity hold insurers. But give us a bit of sense, where can listeners find more about your work?
So again, I think you might have mentioned, but I work as a portfolio manager at TwentyFour Asset Management. We do publish occasionally a blog here with our thoughts in financials and more broadly the market. So I would encourage everyone to subscribe to that.
Perfect. Thanks, Jakub. And thanks also to everyone for listening to Fixed and Floating, the credit podcast. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts. And hear you next time.